Choosing LLC versus C Corp tax wrong in 2026 costs you $8,000 yearly. Here's the real math. Here's the problem. Most founders pick based on startup blogs from 2019. LLC owners save $3,200 in 2026 with qualified business income deduction on the first $182,100. C Corp pay 21% flat federal tax, but you pay again on dividends, doubling your tax hit. You're launching a product business in March 2026. Revenue hits $140,000 by December. You picked C Corp because a podcast said it's better for investors. Now you're paying corporate tax plus personal tax on every dollar you pull out. That dual taxation costs you $11,200 more than an LLC would. Here's why the LLC versus C Corp tax comparison for small business owners in 2026 comes down to three numbers: your revenue, your state, and whether you're keeping profit inside the company or paying yourself. Most people fail here because they optimize for a future fundraise that never happens. Let's fix it with real 2026 tax brackets and a scenario that matches your actual situation. Most people fail here. They assume C Corp status attracts investors automatically. In 2026, venture firms care about traction and terms, not your tax election. You're paying double tax for a signal that doesn't work. The real mistake is ignoring pass-through taxation. An LLC in the same $140,000 scenario pays zero entity-level tax. You report that income on your 1040, pay ordinary rates, and claim the 20% qualified business income deduction under Section 199A. That deduction alone saves you $5,600 on $140,000. Do not do this, picking C Corp before you have $500,000 revenue or a term sheet in hand. Step 1. Run your 2026 effective rate. Take your projected net income. Multiply by 21% for C Corporation. For LLC, use your personal marginal rate minus the 20% QBI deduction if you're under the $182,100 threshold for single filers or $364,200 for joint. The break-even point in 2026 sits around $220,000 in profit if you're reinvesting everything. Below that number, LLC wins by $4,000 to $9,000 per year. ReputationZilla works with founders who switched from C Corp to LLC after year 1 and recovered $18,000 in overpaid taxes through amended returns. Step 2. Check your state. California charges LLCs an $800 annual fee plus a gross receipts tax starting at $6,000 revenue. Delaware C Corps pay $400 franchise tax minimum. Wyoming and Nevada have zero income tax, making LLC the obvious winner there. This is important. If you're in a high-tax state like New York or California, the state LLC fee can eat half your federal savings. Texas has no income tax but charges 0.75% margin tax on revenue above $1.23 million. Run the state math separately. Most tax blogs ignore this, and you end up $2,300 short. Here's the problem. You're comparing two structures without looking at your actual 2026 cash flow. Right now, you're thinking about the entity on paper. After applying step 1 and 2, you're looking at real dollar differences. Before, you see C Corp as the default for serious businesses. After, you see an LLC saving you $7,100 this year because you're taking owner draws, not reinvesting profit. The reset is realizing tax structure follows your money movement, not your brand image. Advanced move for 2026. If you're an LLC making over $182,100 and losing the QBI deduction phase-out, elect S Corp status. You pay yourself a reasonable W-2 salary, say $80,000, and take the remaining $102,100 as a distribution. That distribution avoids the 15.3% self-employment tax, saving you $15,621. The IRS watches this closely. Reasonable salary in 2026 means market rate for your role. If you're a fractional CFO making $180,000, you can't pay yourself $40,000 and call the rest a distribution. ReputationZilla clients in the consulting and agency space use this exact structure to cut self-employment tax by 60%. The exact wording for your accountant is this: I want to file Form 2553 to elect S Corporation tax treatment for my LLC, effective January 1st, 2026, and I need a reasonable compensation analysis for my W-2 salary based on my role and market data. I want to file Form 2553 to elect S Corporation tax treatment for my LLC, effective January 1st, 2026, and I need a reasonable compensation analysis for my W-2 salary based on my role and market data. LLC saves $5,600 with QBI deduction under $182,100. C Corp makes sense above $500,000 reinvested profit. S Corp election cuts self-employment tax 60%. Need help cleaning up a tax mess or business reputation? ReputationZilla handles it. Visit https://reputationzilla.org.